Welcome to PIP Insight Macro, the economic calendar briefing for the daily Forex news. Today is the 20th of July, 2026. This session has 4 high-impact and 1 medium-impact releases coming up. Let's run through exactly what's on the calendar and what it means for the major currency pairs. Canadian inflation data is coming in hot at 8:30 Universal Time Coordinated. This could shake the entire North American session. Welcome to PIP Insight Macro. I'm your host for today's daily Forex news. We've got 4 high-impact events on the radar, and we're zeroing in on euro crosses as they prepare for some serious volatility. Stick around. Here is the full economic calendar for the daily Forex news. We have 4 high-impact releases due this session. Let me walk you through each key event and what it could mean for the markets. We're looking at Canada's monthly consumer price index today, a high-impact release that measures inflation pressure month over month. The forecast is calling for a decline of 0.2% compared to the previous month's 1% increase, which would signal cooling price pressures. This data is crucial because it feeds directly into the Bank of Canada's decision-making process on interest rates. The monthly CPI tells us whether consumers are facing more or less inflation pressure in their everyday purchases, everything from groceries to energy to housing costs. For the Bank of Canada, this is one of the key metrics they monitor to determine if they need to adjust their policy rate. A miss to the downside, meaning inflation comes in even weaker than the 0.2% forecast, could accelerate expectations for rate cuts and weaken the Canadian dollar. Conversely, a beat, if we see inflation holding stronger than expected, would support the loonie and suggest the BOC might keep rates higher for longer. Given we're coming off a 1% monthly gain previously, the market is definitely pricing in some moderation here. Watch for the headline number first, then pay close attention to core inflation components as those reveal underlying price trends. If we see a significant miss, you could see rapid selling in Canadian dollar pairs as traders reprice rate cut odds almost immediately. Dollar Canada is your primary pair to watch here. A weaker than expected CPI print could push the loonie higher and drag this pair lower as the rate cut narrative strengthens. Euro to Canadian dollar and British pound to Canadian dollar will follow similar patterns, with the euro and pound potentially weakening against the Canadian dollar if the data supports Bank of Canada easing expectations. Canada's median CPI year-over-year just hit the wires, and this is a critical inflation gauge that the Bank of Canada watches very closely. We're looking at a flat reading of 2.1% against a forecast of 2.1%, which means we got exactly what markets were pricing in. Let's break down what this means for the Canadian dollar and the pairs you're trading today. Median CPI strips out the most volatile price components to give us the true core inflation trend. It's what central bankers actually care about when they're making rate decisions. The Bank of Canada uses this metric heavily because it's more stable than headline CPI and better reflects underlying price pressures in the economy. A beat would have suggested sticky inflation forcing the BOC to hold rates higher for longer, which would strengthen the Canadian dollar. A miss would have opened the door for more rate cuts ahead. Since we got the exact forecast, markets are likely to view this as confirmation that inflation is on target and policy remains on track. No surprises here. What's important for traders is that this comes against a backdrop of the BOC already in cutting mode, so the narrative around future easing is still the main driver. Watch for any reaction in the first 15 minutes post-release, as this could trigger quick momentum plays or consolidation depending on how broader risk sentiment is moving. Dollar Canada and Euro to Canadian dollar are your primary movers here because both pairs react directly to BOC policy expectations and Canadian dollar strength. A confirmed 2.1 print supports the idea that the BOC can continue its gradual rate cut cycle, which typically weakens the Canadian dollar against its US counterpart and other majors. Expect potential downside pressure on Dollar Canada if markets interpret this as giving the BOC more room to cut, while Euro to Canadian dollar and British pound to Canadian dollar should follow similar dynamics. We're looking at Canada's Trimmed CPI year-over-year reading, and this is a high-impact event that traders need to watch closely today. The Trimmed CPI strips out the most volatile price components to give the Bank of Canada a clearer picture of underlying inflation trends. With the forecast holding steady at 2%, matching the previous reading, this data could be pivotal for determining whether the BOC maintains its current policy stance or signals further adjustments. The Trimmed CPI is one of the Bank of Canada's preferred core inflation measures because it removes extreme price swings in both directions, giving policymakers a more stable view of persistent inflation pressures. This matters tremendously because the BOC uses this metric alongside headline CPI to guide interest rate decisions, and rate expectations are what ultimately drive currency strength. If we see a beat above 2%, it signals inflation isn't cooling as smoothly as hoped, which could support expectations for higher rates or a longer tightening cycle, typically strengthening the Canadian dollar. Conversely, a miss below 2% would reinforce the narrative that inflation is well controlled, potentially opening the door for rate cuts, which would weaken the loonie. Given that the forecast matches the previous print at 2% exactly, traders should watch for any surprise in either direction. Even a 0.1% variance can trigger sharp reversals. Recent context shows the BOC has been cautiously optimistic on disinflation, so a hold at 2% might be interpreted as a Goldilocks scenario, though any tick higher could reignite hawkish repricing across dollar Canada and other cross pairs. Dollar Canada is the primary pair to monitor. A hotter than expected trimmed CPI reading would likely weaken the Canadian dollar and push dollar Canada higher, while a cooler print could spark a pullback. Euro's Canadian dollar also deserves attention because Euro traders will be watching for divergence between ECB and BOC policy paths, and softer Canadian inflation could accelerate that spread trade. We're watching the common CPI year-over-year reading for Canada, which measures the rate of price increases across a basket of goods and services. This is a key inflation gauge that the Bank of Canada closely monitors, and it can significantly influence Canadian dollar strength and interest rate expectations. If we see a beat above the 2.5% forecast, it suggests inflation is stickier than expected, which could support the Canadian dollar as it raises the likelihood of higher interest rates from the BOC. Conversely, a miss below forecast would signal cooling inflation pressure, potentially weakening the loonie as rate hike expectations diminish. The market reaction typically shows up most sharply in dollar Canada and Euro's Canadian dollar, where a weaker than expected print sends those pairs higher. British pound Canadian dollar and Australian dollar Canadian dollar will also react, but usually with less intensity than the dollar crosses. Watch for volatility spikes in the first few minutes post-release, especially if the print significantly deviates from the 2.7% previous reading. Dollar Canada and Euro's Canadian dollar are your primary pairs to monitor, with both likely to move inversely to Canadian inflation strength. A beat supports Canadian dollar weakness, pushing these pairs higher, while a miss typically drives them lower as safe haven demand returns to the currency. New Zealand's quarterly CPI print is hitting the calendar today, and this is a big one for the Kiwi. We're expecting inflation to accelerate to 1.5% quarter-on-quarter, up from 0.9% in the previous period, which would signal rising price pressures across the economy. This data carries serious weight because the Reserve Bank of New Zealand watches it religiously when deciding on interest rates. CPI, or Consumer Price Index, measures the rate at which prices are rising for goods and services that everyday New Zealanders purchase. It's the primary inflation gauge the RBNZ uses to calibrate monetary policy, making it absolutely critical for currency traders. If we see a beat, meaning inflation comes in hotter than 1.5%, it strengthens the case for higher interest rates, which typically supports the New Zealand dollar by attracting yield-hungry investors. Conversely, a miss below 1.5% could signal softening demand and reduce rate hike expectations, weighing on the Kiwi. The previous reading of 0.9% was relatively benign, so this forecast jump to 1.5% represents a meaningful acceleration that markets have already started to price in. Watch for price action around support and resistance levels immediately after the print. Volatile 50 to 100 pip moves within the first minute are common, followed by broader trend confirmation as traders reassess their rate expectations. Kiwi dollar is your primary pair to monitor here. A hotter CPI print should push the Kiwi higher against the greenback as rate differential expectations shift in New Zealand's favor. Euro in New Zealand dollar is equally important because euro traders will react to any surprise that alters the RBNZ policy outlook, potentially pushing the pair lower if inflation surprises to the upside. Both pairs will likely experience sharp directional conviction within the first 60 seconds of the release. We're looking at German Producer Price Index data this session, a month-on-month reading that gives us insight into wholesale inflation pressures across Europe's largest economy. While it's a lower impact release, it can still provide context for broader Eurozone pricing trends. The forecast is calling for a -0.2% decline after the previous month's 0.3% gain, suggesting producer prices may be easing slightly. This is generally mild data that won't typically trigger major volatility, but it does help traders assess whether inflationary pressures are cooling, something the ECB is watching closely. We might see modest interest in euro pairs if the number significantly misses expectations in either direction. Euro-dollar will likely be the most responsive pair, though we should expect only minor ripples given the low-impact nature of this release. We're looking at China's year-to-date foreign direct investment figures, which measure how much capital is flowing into the country from international investors. This is a key indicator of economic confidence and business sentiment toward the Chinese market. With a previous reading of -8.6%, this data shows foreign investors have been pulling back from China. Today's release with low-impact designation suggests markets are already pricing in weak FDI trends, so we may see a muted reaction unless the new figure represents a significant surprise either direction. US dollar Chinese yuan will likely be the most responsive pair if this data shifts market expectations about Chinese economic momentum. We've got core CPI month-over-month data coming in for Canada today, and this is a key inflation metric that strips out volatile food and energy prices to give us the real picture of underlying price pressures. Even though it's marked as low impact, it's still worth watching as it feeds into the Bank of Canada's decision-making process. Core CPI is one of the bank's preferred inflation gauges, but with no forecast provided today, markets might be a bit uncertain about what to expect. A reading that comes in stronger than the previous 0.6% could suggest sticky inflation, while a softer print might ease some BOC rate cut hopes. Either way, any surprise here could nudge the Canadian dollar, though we're not expecting major volatility. Dollar Canada is typically the most responsive pair to Canadian inflation data, as it directly influences Bank of Canada policy expectations and relative rate differentials. We've got the Conference Board leading economic index coming in this morning, and while it's marked as low impact, it's still worth understanding what it tells us about future economic momentum. This index is basically a crystal ball that economists use to predict where the US economy is headed over the next 3 to 6 months. We're expecting a decline of 0.1% month-over-month, following a small gain of 0.1% previously. This suggests some cooling in leading indicators, which could hint at slower economic growth ahead, but the moves are so marginal that we should expect fairly muted reactions across the board. The dollar might see a slight dip if the data comes in as expected, since weakness in leading indicators could reduce Fed rate hike expectations. Euro-dollar is likely to be the most reactive pair, given that any softening in US economic outlook typically strengthens the euro relative to the dollar. Based on today's releases, the pairs most at risk of volatility this session are euro-dollar and euro-pound and euro-yen. Here is a breakdown of why each pair is in focus. That wraps up the complete daily Forex News economic calendar breakdown. The key theme today is Canadian inflation data dominates, euro volatility expected. Keep a close eye on the release times. A surprise deviation from forecast is often where the real moves happen. This is educational content only. Trade safely and manage your risk. Thanks for tuning into Pip Insight Macro. Don't forget to like, subscribe, and hit that notification bell. Follow us on X at @ForexInsight for real-time updates.